All right, let's get right into it, because if you're watching this, you've probably felt that pain. You've seen the charts, you've seen the red, and you're asking yourself, what is going on? Why am I losing money? Bitcoin just took a massive nosedive, and honestly, this time it feels different. There was no big economic meltdown, no major exchange collapse, none of the usual suspects. It's like this crash came out of nowhere, a total phantom. Here at Whale Radar, we're not about hype, we're about finding the real answers. And today, we're gonna pull back the curtain on the hidden reason crypto is falling.
And that right there, that's the central mystery we need to solve. I mean, think about it. If this was really about some big global recession or some geopolitical event, you'd see everything tanking together, right? Stocks, commodities, everything. But that's not what's happening. The stock market is kind of just chilling. Gold is stable. The rest of the world is just business as usual. So the big question is, why is crypto all alone in this freefall? It's a huge red flag that tells us the problem isn't coming from the outside world. Nah, this problem is coming from inside the house. It's baked right into crypto's own plumbing.
You know, history gives us context, and it's super important here. Every single major Bitcoin crash we've ever had, it had a name. It had a clear villain or a clear cause. In 2014, it was the Mt. Gox hack. Boom, clear trigger. In 2018, the ICO bubble popped, leading to that brutal crypto winter. 2020, well, a global pandemic that shut down the entire world. And of course, in 2022, we had the FTX disaster, which sent shockwaves through the whole industry. See the pattern? Every crash had a story. But today, all we've got is a big fat question mark. This is a new kind of beast, and that's why we have to follow the money.
So, this is where we put on our detective hats. We're gonna go way beyond the simple headlines and really dig into the clues that are hiding in plain sight. Now, I want you to think of these next few points not as the final answer, but as critical pieces of a puzzle. Each one is a symptom of a much, much deeper issue that's been building up right under our noses.
Okay, our first clue takes us over to Asia. It's a classic Wall Street move called a carry trade. Here's how it works. Big hedge funds were borrowing insane amounts of Japanese yen, where interest rates are practically zero. Then they took all that cheap money and plowed it straight into Bitcoin, riding the wave up. It's an absolutely genius move when the market is screaming upwards, but it's also a trade that's built on a razor's edge. The second Bitcoin stopped its crazy climb and borrowing started to get just a tiny bit more expensive, the whole thing became a ticking time bomb. They had to sell, and not just sell, but sell aggressively to cover those massive leverage bets. That's our first wave of selling pressure.
Now stick with me here, because our second clue gets a little more complex, but it's so important. It's a market phenomenon called negative gamma. The easiest way to think about it is like a snowball rolling down a hill, getting bigger and faster on its own. See, when big banks sell financial products linked to Bitcoin's price, they have to hedge their own risk. But their risk models are set up so that when the price falls below a certain point, they are automatically forced to sell more Bitcoin to rebalance their books. You see the problem? The more they sell, the further the price drops. The further the price drops, the more they're forced to sell. It's a purely mechanical, unstoppable death spiral that has zero to do with human emotion or market sentiment. It just happens. And for our last clue, we look at the very foundation of the network, the miners. Right now, the AI industry is absolutely exploding, and guess what it needs? Tons of high-powered computing, the exact same kind miners use. So some miners are starting to think, hey, maybe servicing AI is a better business? We're seeing hash rates decline in some areas, which tells us there's real stress out there, especially after the halving squeezed their profits. But, and this is the key part, when we look on-chain, the big miners haven't actually started dumping their huge bags of Bitcoin on exchanges. So yeah, it's a sign of pressure, but it's more like a slow leak, not the sudden fire hose of selling that we just witnessed.
So let's recap. We've got a carry trade blowing up, we've got a mechanical selling spiral, and we've got miners feeling the pressure. But here's the pivot, the most important takeaway so far. These are all just symptoms. They're the tremors, not the earthquake. The real reason for this crash, the tectonic plate that's shifting underneath the entire crypto market, is a fundamental change in the very structure of how we trade Bitcoin.
And this brings us to the big reveal. The true reason for this phantom crash isn't just one single thing. It's not one bad guy or one bad trade. It's the fact that the entire engine of the crypto market has been secretly rebuilt over the last couple of years. We've moved from a market built on a solid foundation of real assets to a market built on a fragile foundation of synthetic risk.
Just look at this number for a second, 70 to 80%. What do you think that is? Is it the percentage of investors who are down? The drop from the all-time high? Nope, It's something way more fundamental. Something that explains literally everything about the chaos we're seeing right now.
That 70 to 80%, that's how much of all crypto trading volume comes from derivatives. We're talking futures, options, perpetual swaps, all the complex financial instruments that are basically just bets on the price. Think about that. The market is no longer driven by people buying and selling actual Bitcoin to hold in their wallets. The vast, overwhelming majority of the activity, the force that actually moves the price, is now driven by leveraged speculation. The tail is officially wagging the dog.
And this really highlights the two different worlds that are at war in crypto right now. On one side, you have the spot market. That's buying and selling the real thing. And on the other, you have the derivatives market. That's pure speculation. Understanding the massive difference between these two is the absolute key to navigating this market and protecting your capital. Let's just break it down nice and simple. The spot market is a market of conviction. You buy Bitcoin because you believe in it, you hold it, and that creates real supply and demand. It's naturally more stable. The derivatives market, on the other hand, is a market of convenience and leverage. Price doesn't move because thousands of people change their minds. It moves because of a mechanical liquidation of risk. It creates this synthetic selling pressure that can trigger a domino effect of liquidations, crashing the price without a single long-term holder ever selling a coin.
And this is the bottom line. This is what you have to understand. When you see a massive red candle on the chart today, it's probably not thousands of believers panic selling. What you're actually seeing is a much smaller group of over-leveraged traders getting wiped out, automatically liquidated by an exchange's risk engine. The modern crypto market isn't designed to trade an asset based on belief anymore. It's been optimized to eliminate financial risk, and it does it with brutal mechanical precision.
So, if the problem is a market built on this fragile house of cards, what's the solution? How do we find a real bottom and start a healthy, sustainable recovery? Now we're going to talk about the path forward. And look, if this is the kind of deep dive analysis you need to actually understand the markets, not just react to them, then you need to be subscribed to Well Radar. Hit that subscribe button and join our free Telegram channel. This is where I share unique insights and trade setups you won't find anywhere else. All right, let's talk about building a real bottom.
Okay, from a pure chart perspective, these are the levels that matter. That $75,000 level was a huge weekly support, and once it broke, it was like opening the floodgates. Right now, we're in a dogfight around $60,000, trying to hold the line. But honestly, a lot of serious traders are looking down towards that $50,000 area. That's a major historical support level, and it might be the point where real long-term buyers finally step in with enough cash to soak up all this selling.
But listen, lines on a chart don't build a foundation. For a real, healthy recovery, the market needs to change from the inside out. We need a massive flow of real money back into the spot market. People buying actual Bitcoin, whether it's on an exchange or through those new ETFs. And just as important, we need a change in mindset. We need a community that's focused more on long-term holding and building and less on short-term, high-leverage gambling.
And that really leaves us with this final thought. What we're seeing right now isn't just random price action, it's an identity crisis for the entire crypto space. Is this an asset class for long-term believers to build on, or is it just a 24/7 global casino? Because a market that's just full of speculators is always going to be doomed to these violent, gut-wrenching swings. But a market of believers, that's how you build a real, lasting foundation. The big question we all have to answer is which market is going to win.